Welcome everyone to this absolutely crucial explainer. Today we're going to break down the bare essentials of end of financial year planning. We'll be drawing on some incredibly valuable recent insights from Trinity accounting practice. So whether you manage a long day care, outside school hours care, or family day care, this explainer is built specifically for you. Let's get into it.
Right off the bat, let's start with a hard truth. Running a childcare center today takes an incredible amount of precision. You're dealing with regulated revenue that's partly subsidized through the childcare subsidy, your operating costs are heavily dominated by rising award wages, and the compliance load, well, let's just say it multiplies faster than a room full of toddlers during a sugar rush. So the really big question you have to ask yourself right now is this: are you truly ready for that June 30 deadline, or are you just waiting around to react to the outcome?
And this brilliantly illustrates the stark choice you have in front of you. Waiting until August to look at your numbers is frankly a very expensive mistake. By the time the financial year has completely closed, almost every lever you could have pulled is just gone. Your tax outcome is locked in. But if you look at your numbers right now in May and June, your planning levers are still highly active. You can still make those strategic decisions that legally minimize your tax and optimize your cash flow before the year actually ends.
To get you there, here's our Follow the Money roadmap. We are going to quickly cover the June 30 deadline, maximizing deductions, super and ATO compliance, state taxes and BAS, and we'll wrap up with KPIs and future-proofing. Okay, let's dive into this first one, the proactive year-end review. The single most valuable action you can take today is booking a planning meeting with your tax agent by mid-June. Why? Because you absolutely need to project your full-year childcare subsidy revenue and occupancy to see where your taxable income will actually land. If your center's income has shifted over the year, you've got to review your PAG installments before your next BAS is due. Think about it. If your installments are too high, you're unnecessarily tying up vital cash that you could be using elsewhere. But if they're too low, you are quietly building this massive debt that is going to hit you so hard at lodgement time. Right, moving on to Section 2. Let's talk about pulling those immediate cash levers and maximizing your deductions. This right here is the big ticket item for the 2025 to 2026 financial year. The instant asset write-off threshold is $20,000. If your business has an aggregated annual turnover of under $10 million, you can immediately deduct the business use portion of eligible assets that cost less than $20 grand each. Now, what's really interesting here is that this deduction applies per asset. That means multiple items can qualify. You could write off completely new playground equipment, commercial kitchen appliances, upgraded IT and software systems, new furniture, or even just a fresh batch of sleep mats. But there is a very hard deadline you cannot miss. To claim it this financial year, these items must be installed and completely ready for use by June 30. Simply paying for them on June 29th isn't enough. They literally have to be in your center and ready to go. Let's shift gears to Section 3, managing your largest cost line, your staff, and the strict ATO rules around them. Superannuation rules are shifting, folks. First off, you need to ensure your payroll and rosters are accurately costed at the 12% super guarantee rate. Second, and this is a massive tip, pay your June quarter super early. Ideally, get it done by mid to late June. Employer super is only tax deductible in the year the fund actually receives it. So if you hit pay on June 30 and it takes your clearinghouse 3 days to process it, you completely lose that deduction for this financial year. And finally, get your single-touch payroll finalization ready by July 14 so everyone's income statements are correct. Let's move to and see how this builds because you absolutely need to get this right. A major disruption is on the horizon. While the super guarantee hit 12% in July 2025, the real game changer is coming in July 2026 when payday super begins. Super will literally have to be paid at the exact same time as wages, reaching the fund within 7 business days of payday. For wage-heavy childcare centers that are used to paying quarterly, this is going to cause massive cash cycle compression. You need to be modeling the cash flow impact of this change right now. Alongside super, you have got to keep your house clean when it comes to compliance. Division 7A is this complex ATO rule, but simply put, it catches undocumented loans, payments, or forgiven debts from a private company to its owners. If you don't get these loan agreements properly documented before lodgement, the ATO can treat that money as an unfranked dividend, and no way do you want that expensive audit risk. Also, taking a step back from company structures entirely, double-check your contractor classifications before year-end. Accidentally misclassifying a relief educator or a cleaner as a contractor when the ATO thinks they should be an employee for super or PAYG is a super common and incredibly costly mistake.
Okay, Section 4. Let's look beyond the federal obligations and tackle the complex state-specific nuances.
State taxes vary widely, and they can be a real headache. Take payroll tax, for instance. It's based on state-level thresholds, but the real catch is the grouping rules. If you run multiple centers, your wages are often aggregated across your related entities, suddenly pushing you way over the threshold. Multi-site operators get caught out by this all the time, for sure, so confirm your grouping position before year-end. Land tax might also apply depending on your property's value. And lastly, GST. While the childcare you provide is GST-free, your inputs are definitely not. Make sure you're actively claiming those input tax credits on your BAS to get those refunds you're entitled to.
And finally, Section 5. Let's pivot from compliant survival to actual business optimization.
Look, tax is really only half the battle at EOFY. The other half is deeply understanding your center's economics. The stakes here are incredibly high. At current award wages, most long daycare centers need roughly 75 to 85% occupancy just to break even. If you cannot immediately state your break-even number right now, that is literally the very first thing you need to fix.
To truly future-proof your center, you've got to build a KPI scorecard. Track essential measures like occupancy by room, parent fee debtor days, the CCS reconciliation gap, your wage cost as a percentage of revenue, and your casual to permanent ratio. The real trick here is to merge the data from your enrollment system directly with your accounting software, like Xero. You want one unified picture of your business. Because honestly, trying to cross-reference two completely different systems at midnight, yeah, that's a headache you definitely don't need.
And if you're future-proofing, you might be thinking about succession. Whether you're planning a sale, retiring, or maybe bringing in a partner, this takes long-term strategy. The Small Business Capital Gains Tax, or CGT concessions, can substantially reduce your tax on a sale. But eligibility depends on strict tests that are much easier to satisfy when you plan for them years in advance. Don't scramble for this at settlement. Start your planning right now.
So the crucial point is captured perfectly in this insight from Trinity Accounting after their 22 years in practice. The most successful childcare operators aren't necessarily the largest ones. They're the ones who treat 30 June as a planning deadline, not a reporting date. They sit down in May and June with projected numbers, making smart, proactive choices while those levers are still active, rather than reacting in August when it's entirely too late. Which brings us to our final thought today. Is your center truly ready for July 1st, or are you kind of just hoping for the best? Hope is not a financial strategy. Take stock of your business, grab this checklist, book that mid-June meeting, and take back control of your center's future. Thanks for joining me on this explainer. We'll see you next time. Now go make those numbers work for you.